So we have seen that in sole traders, it's a business that is run by one person. He gets capital, maybe from a loan, maybe from the savings, or maybe he sold a personal asset, and then he starts the business. And the business, you have seen the financial statements of a sole trader. So these are the businesses that are formed by two or more persons in partnership, as we have seen in the law of persons, where two or more people come together to start a business with an aim of profits. So we have a minimum of 2 and a maximum of 20 in partnership. But in the case of professional firms, the auditing firms, the lawyers, practicing lawyers, and others, they have a minimum of, they don't have a maximum. And for the banks and financial institutions, if people come together as a partnership to start a bank, a partnership business, it is established through an agreement. We call it a partnership agreement or a partnership deed. So they agree on so many things, like the amount of capital to be invested by each partner, the profit sharing ratio. So you'll find that there will be 2 or more persons that come to start the business. So in this business, each one of them will contribute a certain amount of capital. So they will agree. You bring 1 million, I bring 1 million, another brings, and so on. Then you start a business. Then this business is making profit. So they will have to agree. When we make profit, how are you going to share the profit? So they will also agree on the profit sharing ratio. Then you have this capital they have invested. If that person would have invested that money elsewhere, he could be getting an interest, isn't it? But he has decided to invest it in business. Then the money now is generating the profit. So this money that he has invested, the partners will agree on interest on capital. So we have said the first thing they agree on is capital contribution. Capital contribution. Number 2, profit sharing. Number 3, interest on capital. So we shall agree that because you have invested 1 million in this business, every year you'll be getting 5% or 10% or any percentage of that money as interest on your capital. Then there is salaries. Some of the partners will be working in the business. Maybe one will be a manager, the other will be a driver or something, or any work that he will be doing in that business. They will be working there. So they will be getting salaries. Salaries to partners. Okay? We will agree. If you will be the manager of the business, then we will agree that we will be giving you a salary of 50,000 per month or any amount that we are going to agree on. That is another thing that we agree on. Then the limits to drawings. So this is our business. Sometimes we saw even in sole traders, they will withdraw money for personal use, isn't it? Yeah, the sole trader can take money from the business and pay school fees for the children. Yeah. Or he buys an asset for home, maybe a television or something. We saw in the question that some in the salaries and wages, they include amount paid to domestic workers of the sole trader. Those are the things. The same with partnerships. We can have a scenario where a partner will withdraw money from the business for personal use. So the partners will agree, yes, we will be having drawings, but to a certain limit. Nobody will be drawing more than 5,000 per week. Nobody will be drawing more than 10,000 per month. Okay. The same, they have agreed to the salaries of the partners who are working. They will also agree to the limits on drawings. Then these drawings, if you draw cash from the business for school fees, maybe you can go to university, you can 50,000 unalipa fee. That money will be attracting an interest. At the end of the year, there's some interest it will go, you pay to the business. So we are going to agree on the interest on drawings. Okay? That is where it comes in. So some partnership agreements may also guarantee minimum share of profit for one or more partners. Yeah, sometimes they can agree on a guarantee profit for a certain partner. Maybe one of the partners may invest heavily, so he will have a guarantee share. All those, they are agreement. But sometimes, some people, they just start the business without an agreement. Okay? Yeah, watu wawili wamegraduate ni wa beauty wameweka salon pamoja wameanza job. They don't have the agreements like this. If there is no agreement, then the profit and losses will be shared equally. And also, there will be no partner salaries, and there will be no interest on capital. And partners will be entitled to interest of 4% per annum on any loans that they get from the firm. That is what we have. Now, in the partnership accounts, we have some items that we never saw in the sole traders account. We have the capital account. The capital account of partnership, unlike the capital account of the sole trader, who is one person, the capital account of a partnership looks like this. So this is a case of two partners. Okay? This is particulars. This is maybe you have partner A and partner B. Particulars, partner A and partner B. That is the capital account. Just like the way you would have A and B. If there are three partners, because we are going to see the questions where you have three or even four partners, it's just these columns that we add. A, B, C, and D. A, B, C, and D. So, that is one. Now, in the capital accounts, what are the amounts that should be in that account? One of them is the balance. The capital account, the balance is here. Okay. Then we have what? If there is any additional capital, maybe A added or B added capital, we just add it there. Then, if there will be any capital gains on revaluation. So a partnership business that has been there for a long period. When we were talking about the assets, we saw revaluation, isn't it?
Yeah.
What is the revaluation? A situation whereby the asset has been there for a long time and it is fully or almost fully depreciated. So the figures in the books, they are running to zero. But the asset is still in good use and can continue being used for another period of time. So we come and give it a new value. That is why we call it revaluation. In a business, the evaluation is carried out by qualified actuaries in companies. But in small businesses, like sole trader or partnership, the directors, the owners of the business, they can be able to revalue their assets. You have been using a motor vehicle for 20 years and it is still in good use. So you can say maybe it will go for another 10 years and you give it another value. But in limited companies, the evaluation is done by a professional, an outsider. So if you have gain on an evaluation, that is a capital gain, isn't it? Yeah, gain on evaluation. That's a capital gain. Also, a business that has been operating for quite some time, it acquires something we call goodwill. What is goodwill? Definition of goodwill. Goodwill is a reputation of a business. It comes about by a business having the power to attract more customers than the similar businesses in the same industry. So you have this business here, and you have another business, the same business, but you can see there is one that is thriving. That is, it shows it has goodwill. So this goodwill, it is valued. It is an intangible asset for one. And then we come and value the amount of goodwill, we give it a value. So if we gain a goodwill, it is a capital gain. Okay? Yeah. Sometimes we lose goodwill. If we have goodwill written off, we write it off on this side. Okay? Yeah. So we divide, we do this, we value the goodwill. We see we have a value of goodwill, we have a goodwill of 400,000. Okay? So we divide it among the partners according to their profit sharing ratios, and every partner gets his share of goodwill. So sometimes we reach a year and we see nowadays competition is so quite tough, such that our goodwill now it is 300,000. So it means you have written off 100,000. This one you divide it in the profit sharing ratios and apportion it to the partners and put it in the debit side. Sometimes the revaluation does not always lead to gains. Sometimes you have revaluation loss. Revaluation loss. You put it here. Okay? Yeah. Then you will get the balance carried down, and that will be our capital account. We're going to look now at a question whereby we're going to put now the real figures. So that is the capital account. It is current account. Apart from capital account, in partnership, we maintain a current account. Current account looks like this. Like that. This is particulars. Partner A, partner B. Partner A, partner B. This is the credit side, this is the debit side. It is just the same account, it's only that you have two partners because it is partnership. If there are three partners, you have said you have C and B, C like that. Okay? Yeah. Then the current account, it records the movement of partners' earnings. And items that increase earnings to the partners are credited, and those that decrease, they are debited. So our balance will be here. account where you're gonna debit balance. It shows balances on this side. But it is normal to have a balance breakdown on this side. Okay?
Yeah.
So your question will tell you where the balance breakdown is. It is either debit or credit side. Then here we record things like interest on capital.
Yeah.
We have said the partners earn interest on the capital. So whatever the amount you calculate here, if it is 5% of the capital, 5% of the 1 million, that amount you put it here for A and for B. Those details will be clear in the question. So you see, you just put it here. Something like salaries. If any partner is paid salaries, if it is A, we put it here. If it is B, we put it here. If it is both, they have like this. Sometimes you find it's only one partner who is getting salary. Credit here. Then the question we have told you. Salaries and wages include this amount that was paid to partners. So kazi yako ni kuepusha. Kama imewekwa different salaries ya staff and salaries ya partners, you know how to treat the two of them. The salaries to staff, that is a normal expense in the expenses in the income statement. But salaries to partners, you're going to put it in the current account. Then, for drawings, a partner has drawn some money from the business, so that money will attract interest. That interest is an income to the business, isn't it? Like interest on capital is a loss to the business because you are paying the partners. But interest on drawings is an income because they are partners, they are paying to the business. So the interest on drawings, you put them here. Interest on drawings. Whoever has drawn, if they are both, you put both. Okay? And also the drawings themselves. Tibado wamebeba pesa, kampuni ama goods. Okay? Then from there, you have, before the balance carried down, there is the share of profit. Share of profit is put there, and if it is loss, it is here. If the net profit was net loss, we put it here. I'm going to make a hapa in brackets, but I prefer put it in here. Okay? So you cannot get profit and loss at the same time.
Yeah.
So it will be either loss or profit. Then there is loan, interest. Sometimes the partners, they take a loan from the business, and that loan attracts an interest.
Yeah.
So you put it here, loan, interest. Whoever has taken a loan and has paid as an interest, it has accrued, it is there. Okay?
Yeah.
And then you do what?
Close.
You close, you get the balance carried down. Balance carried down can be on either side,
Yeah.
not on both sides.
Yeah.
Then that is the current account. Like that. So, profit sharing. The division of profits among the partners. So the profit from the partnership is divided in accordance with the ratios that were agreed in the partnership deed.
Yeah.
So we said the ratio is 3:1. We will be given clearly in the question. In the normal working environment, there will be the deed itself. You will read and know this is the sharing ratio. Okay? So you will calculate that profit sharing ratio, and then in the sole proprietorship, we learned the final accounts. That is the income statement. It has the trading statement and comprehensive income. The trading statement sales less cost of sales. You get what? You get gross profits. You less expenses. You get what? Net
Profit or net loss.
net profit. Net profit in brackets loss. We have shillings, shillings, shillings. So our net profit is here. Then we go ahead and do what? Appropriation. Okay? In the appropriation accounts, it is an extension of the statement of comprehensive income, showing how the partnership profit was shared, and then in arriving to the amount that the partners will take home. So then you add interest on drawings. So we have partner A and partner B. So you put them here, A and B, you add, you put the final figure here, okay?
Yeah.
Then what else? Interest on capital, you less interest on capital, A and B, you add these two, you bring the final figure here, and then this is minus. Okay? Then you less what? Salaries. A, B. A and B, they are the names of the partners. You add, you get here, you less. Okay?
Yeah.
Less like that. Then, when you have less like this is what? Now the profit to be shared. This amount here, then you come here down and say share of profit. So this profit is shared equally between A and B. This is 100,000.
Yeah.
So A will get what?
50.
50. B will get 50. You add them together, you get what? Yeah, this one will be this one. Because it is the one that you have divided. That is the appropriation account. The statement of financial position. Statement of financial position, as at a given date, assets, they are the same. Mostly in partnership, you'll have goodwill. So assets, after you have done the non-current assets, remember we said the non-current assets are arranged in the order of permanence, from the most permanent downwards. Then after that, now you can recognize the intangible asset, goodwill, and any other. We have other examples of intangible assets, patents and copyrights.
Yeah.
Then current assets, we arrange them in the order of liquidity, from the one that is far away from being transformed into cash down to cash. Then from there, we go to capital and liabilities. So in the capital and liabilities section, we start with capital. Why will you get the balance for capital? From the capital account that we started with. Okay?
Yeah.
So our capital account will have A and B. Then the total. Okay? Then you add what? Current account. Okay? The current account that you prepared, the balance that you have, If it's on the debit side, itakuwa hivi. Si ndio? Yeah. So tutasema iko sawa on the credit side. So our current account will be like that. We'll add. Now this will be our, yeah. Unlike the sole trader where you are having capital, add what? Net profit, less drawings. Yeah, this one when you add what is in the current account has the share of profit and it has the drawings and all the other items. So you just add it there and then you come now to current liabilities. Okay, you list them and then you get your final figure.